American farmers spent $8.4 billion last year just to move irrigation water. That spending helps irrigated farms generate over 50% of all U.S. crop sales, even though irrigated land covers less than 17% of harvested cropland. A small footprint carries outsized economics. Every new sensor, pipe, and pump is sold as an efficiency breakthrough. This episode asks a harder question. What if better efficiency does not mean less depletion? We track how the 19th century Jevons paradox can worsen aquifer stress, and why billions in public subsidy may be accelerating the very crisis it was designed to prevent. Start with the planetary baseline. Agriculture uses about 70% of freshwater withdrawals worldwide. That makes irrigation policy a resource policy, not just a farm management choice. At that scale, U.S. choices carry global weight. The 2022 census counted 54.9 million irrigated acres in the U.S. By 2023, USDA's Irrigation and Water Management Survey counted 212,714 farms, irrigating 53.1 million open acres. This is a backbone. Small shifts can move totals. In 2023, those farms applied about 81 million acre-feet of water. That was a 2.8% decline from 2018 totals, when irrigation use hit 83.4 million acre-feet across 55.9 million acres. Application intensity fell, but structural dependence stayed high. Half of irrigated acres are concentrated in 5 states: Arkansas, California, Idaho, Nebraska, and Texas. This concentration amplifies drought and policy risk. Local governance choices can carry national consequences. Groundwater from on-farm wells supplied 54% of all irrigation water applied. Average lift depth sat at 241 feet. That depth converts water delivery into an energy problem immediately. Deeper pumping means higher recurring cost pressure. The system is physically large as well. Farmers operated 456,058 wells across 114,889 farms. That hardware base is hard to retrofit quickly, so legacy decisions can lock in future water behavior. The cost stack confirms the pressure. Irrigation energy costs alone reached $3.3 billion. Infrastructure added another $3 billion. Irrigation labor added $2.1 billion more. $8.4 billion just to keep water flowing. For most of the 20th century, gravity irrigation dominated U.S. practice. Furrows, graded basins, and polypipe setups moved water mainly with slope. Capital entry was low, so gravity systems stayed durable, even when performance was weak. Setup could run as low as $50 per acre, but application efficiency in standard furrow systems often sat at 40 to 60%. So a large share of pumped water never reached root zones. Cheap setup hid expensive water waste. Deep percolation made that leak visible. On sandy loam soils under decent management, deep percolation can consume 25% of every gallon pumped. That is a major loss channel, and it also helped justify pressurized conversion. Pressurized systems were built to solve this gap. Center pivots with low-energy precision application can push efficiency above 90%. Subsurface drip can run 95 to 98% by placing water directly in root zones. At nozzle level, these engineering gains are real. Across the 17 western states, the transition looked dramatic. Gravity's share of water applied fell from 71% in 1984 to 41% by 2013. That is a structural shift, not a seasonal fluctuation. Pressurized acreage expanded in parallel. It grew from 14.7 million acres to 29 million acres by 2023, covering 75% of all irrigated cropland. Gravity acreage moved the other direction, contracting to about 9.8 million acres. The old system did not disappear, but it became the minority configuration. Now zoom out to national withdrawals. U.S. total withdrawals peaked before 1970, then fell to 355 billion gallons per day by 2010, a 13% decline from 2005. On paper, the macro trend looked encouraging. The decline continued by 2015. Total withdrawals dropped another 9% to 322 billion gallons per day. Freshwater withdrawals accounted for 281 billion gallons per day within that total, with irrigation alone pulling 118 billion gallons per day. Agriculture remained the defining freshwater user. Any rebound effect inside irrigation dominates the system. Application intensity also improved at field level. Average water applied per irrigated acre moved from over 2 acre-feet in 1979 to about 1.5 acre-feet by 2023. Yields still rose over the same period. That is why the paradox is so easy to miss. The contradiction appears in groundwater data. The High Plains Aquifer spans 8 states from South Dakota to the Texas Panhandle. Monitoring has tracked about 9,000 wells since pre-development conditions. The record shows depletion, despite efficiency gains. Estimated cumulative loss is about 330 cubic kilometers. That equals roughly 8% of pre-development storage. And the depletion is highly concentrated spatially. Nearly 1/3 of total volumetric loss sits in only 4% of aquifer area. Nebraska is the outlier in the positive direction. Average decline there is only 0.3 meters, held stable by heavy sandhills recharge. So one aquifer can contain very different local realities. The southern high plains tell the opposite story. Much of that region pumps fossil water that accumulated over 13,000 years. At farm timescales, that stock is functionally non-renewable. Once depleted, recovery is not a planning assumption. Average declines already show the divergence. Mean water table decline exceeds 7 meters in Kansas. In Texas, mean decline exceeds 11 meters. These are not minor operational adjustments. Wallace County, Kansas is even more severe. It has lost about 80% of historical groundwater storage. Local levels have fallen about 7 feet per year. At that pace, farm viability compresses quickly. Forward projections are blunt. About 35% of the southern high plains may not support commercial irrigation within 30 years. This is a production capacity warning, not just a conservation warning. It directly affects regional output. Texas planning data aligns with that trajectory. State water plans project a 6.9 million acre-feet shortfall by 2070 and a 32% decline in total groundwater availability. Long-run scarcity is already in official planning baselines. California shows the same stress pattern through a different system. The Central Valley has lost about 80 cubic kilometers since the 1960s. That decline happened during major technology upgrades. Efficiency alone did not prevent basin drawdown. When drought intensifies, surface allocations can collapse. The Bureau of Reclamation has issued 0% allocations for classes of agricultural contractors. That forces abrupt substitution into groundwater pumping. Emergency switching speeds draw down. The Tulare Basin illustrates the scale of that shift. Water tables there have fallen about 120 meters. At that depth, pumping becomes an economic and energy burden as much as a hydrologic one. Infrastructure can run while balance sheets deteriorate. Energy shocks repeatedly shaped conversion timing. The 1973-74 oil crisis quadrupled crude prices and exposed weak flood irrigation economics. Energy volatility turned irrigation design into risk management. Farmers adjusted quickly. A second shock arrived in early 2022. Crude rose about 350% relative to April 2020 levels after Russia's invasion of Ukraine. That repriced pumping costs quickly. Irrigation technology decisions moved from optional to urgent. At farm level, operating costs made the incentive clear. A poorly maintained diesel pump can cost about $13,336 per year to run. An optimized electric pump can cut that to about $5,620. Annual savings can exceed $7,700. Crop economics changed at the same time. In 1964, alfalfa and cotton dominated irrigated acreage. Later, Chinese feed demand and renewable fuel standard ethanol mandates changed returns. Water moved toward crops with stronger revenue pull. Irrigated corn reflects that shift. It grew from under 2 million acres to over 12 million acres between 1964 and 2017. Corn became the country's most widely irrigated crop in the process. Scale amplified groundwater exposure. Irrigated soybeans followed a similar trajectory. rising from under 1 million acres to nearly 10 million acres. That expanded risk and resilience at the same time. More acreage meant higher dependence on stable water delivery. Arkansas field data shows why producers adopted. From 1979 to 2018, irrigated soybeans yielded 12.6 bushels per acre, above non-irrigated fields. Yield variance narrowed, reducing flash drought exposure. For operators, irrigation became a hedge. California's adaptation moved through crop value. Surface gravity's share of irrigated land fell from 66.9% in 1991 to 30.1% by 2016. Lower margin field crops gave way to higher value perennial systems. Capital intensity rose with expected returns. Micro-sprinkler and drip expanded alongside that transition. Their combined share climbed from 15.8% to 56.3%. Technology adoption followed crop economics, not just conservation goals. Water strategy became portfolio strategy. The capital burden remains heavy. A quarter-section center pivot covering 125 to 132 acres can cost $75,000 to $150,000 in hardware alone. That is before wells, power, and pipeline integration. Entry barriers remain real. Once full system components are added, total cost approaches $153,000. That translates to roughly $1,100 to $1,200 per acre. Financing structure then determines who can adopt and who cannot. Adoption is as much about cash flow as technology. Higher-end options cost even more. Variable rate irrigation pivots run about $130,000 to $260,000 per unit. Commercial subsurface drip can run $1,800 to over $3,000 per acre. Advanced efficiency is capital-intensive by design. Early year economics are often negative. Year 1 can run about negative $830 per acre for center pivots, and around negative $2,020 for subsurface drip. Break-even usually arrives between years 3 and 5, so liquidity determines transition speed. Labor savings are a major part of payback. On a 150-acre parcel, gravity irrigation labor, near $26,000, can drop to about $3,000 under a pivot. That is a large operational shift. Reduced labor volatility also lowers execution risk. Longer-term asset value helps support financing. After a decade, center pivots can retain about 50% of original capital value in secondary markets. At year 10, risk-adjusted net present value can reach $1,410 per acre at an 8% cost of capital. Gravity stays around $210. Public funds close much of the adoption gap. EQIP issued more than 46,000 awards in fiscal year 2024, the highest volume in 15 years. Subsidy design has become central to irrigation modernization. Private return alone does not drive full conversion. In 2023, EQIP directed over $73 million to sprinkler contracts, averaging $48,436 each. It also directed $67 million to pipeline installations, averaging $24,266. These are not symbolic grants. They materially alter project feasibility. Regulation is tightening. California's Sustainable Groundwater Management Act requires sustainability by 2040 in critically overdrafted basins. During extreme drought, switching to micro-irrigation rises 0.11 percentage points per additional severe week. Climate and policy pressure now move together. State programs vary. Kansas offers up to $500 through its Irrigation Technology Initiative for pump and pivot assessments. Nebraska's 23 natural resources districts use moratoria, flow meters, and volumetric allocations, with 50% cost share capped at $5,000. Now, the paradox becomes unavoidable. Policy assumes better on-farm efficiency means less aquifer depletion. Jevons observed the opposite dynamic in the coal era. Lower unit cost can increase total consumption. Irrigation follows that logic. When efficient delivery lowers the marginal cost per useful gallon, producers often expand irrigated acreage. They may shift into higher revenue crops that consume more water. They may raise application rates to chase yield ceilings. A second mechanism matters just as much. Flood systems were inefficient, but part of that waste returned to aquifers through percolation. High-efficiency systems channel more water into transpiration and evaporation. Return flow can approach zero at basin scale. Kansas evidence shows rebound directly. A High Plains longitudinal study tracked a program paying 75% of conversion costs for dropped nozzle pivots. Econometric results found groundwater extraction increased by 3%. Nozzle efficiency rose, while extraction rose. International evidence points the same way. In Pakistan and India's Indus Basin, rebound estimates were 120 to 180%. That is full backfire relative to expected savings. Consumption rose faster than efficiency gains. China's humid regions showed rebound at 67.7%. Australia's Murray-Darling Basin showed subsidized irrigators extracting 21 to 28% more than unsubsidized peers. Different climates produce the same directional risk. Subsidies without caps amplify use. Sheridan County, Kansas, showed a workable exception. Producers formed a local enhanced management area with voluntary 5-year volumetric limits. The key move was enforceable local allocation rules, not hardware. Governance converted efficiency into conservation. Inside that LEMA, water use intensity fell 16 to 31%. Energy pumping costs dropped about $5.48 per acre. Those are meaningful gains at operating scale, and they came without reported collapse in farm outcomes. Irrigated acreage and profitability showed no major penalty there. That result addresses the standard objection. Producers can conserve and stay solvent when rules are credible. Efficiency needs governance to produce basin benefit. Competition for water is expanding outside agriculture. Proposed AI data centers in the Texas Panhandle may require 1.9 billion gallons per year for cooling. Under rule of capture, landowners keep broad pumping rights with limited oversight. That raises allocation conflict risk. Meanwhile, scheduling practice still lags technology headlines. In Pennsylvania, 2,362 farms were surveyed on irrigation timing methods, outrunning management upgrades. Of those farms, 2,095 scheduled by visually checking crops. Another 1,341 used manual soil squeezing. Only 130 used soil moisture sensors, and just 30 used daily evapotranspiration reports. Another 41 triggered irrigation by watching neighbors start pumping. That behavior is understandable under uncertainty. It is also a clear optimization gap. National data shows the same gap at scale. Fewer than 30% of irrigators use weather networks, subterranean sensors, or commercial scheduling services. Hardware modernization is ahead of decision modernization. That gap drives avoidable extraction. The investment wave is accelerating anyway. Smart irrigation was a $1.52 billion market in 2024. Forecasts put it near $2.51 billion by 2033, implying about 5.7% compound annual growth. Irrigation automation is growing even faster. That market was about $7.2 billion in 2025, with forecasts placing it around $12.4 billion by 2030. Expected growth of about 11.5% annually. U.S. irrigation machinery shows similar momentum. The domestic market was about $7.9 billion in 2024, with forecasts near $17.9 billion by 2033, about 9.52% compound annual growth. Technology penetration is expected to keep rising. Over 35% of global irrigation systems may carry smart tech capabilities by 2026. AI is expected to manage up to 40% of farmland water use. Governance is not scaling that quickly. The industry footprint is already large. U.S. irrigation generated about $8.92 billion in direct spending in 2020, with indirect impacts reaching about $23.3 billion. Sector activity supported roughly 167,000 jobs. System composition is also shifting. Real-time sensor systems held about 45% market share in 2024. The sensor subsegment advanced at about 17.2% compound annual growth. Data infrastructure is becoming a core irrigation asset. Drip is also taking share, holding about 42% of the market. Subsurface drip is projected near 16.8% compound annual growth through 2030. Efficiency hardware is now the default direction of travel. Performance gains can be dramatic at plot level. Matching irrigation to evapotranspiration can lift productivity by up to 34.9%. It can also save about 48% of water versus manual scheduling. Field-level economics strongly reward precision. Labor economics reinforce that reward. Automated scheduling can cut labor by 60 to 80%. Autonomous tractors running 24 hours can reduce direct labor costs by up to 40%. Related equipment markets are projected around $55.3 billion by the early 2030s. Scaling the transition requires finance. Estimates call for $250 billion to $430 billion annually over the next decade for climate-resilient food systems. Water modernization is a major component of that total. Capital access shapes who adapts first. The projected upside is also large. Better water management could help sustain 10 billion people. It is also linked to about 245 million long-term jobs in transition scenarios. That is why policy appetite remains high, despite rebound risks. Market-linked conservation models are already active. Indigo Ag has issued nearly 1 million verified credits through the Climate Action Reserve. Reported conservation exceeds 64 billion gallons of water. Verification frameworks are moving from pilot to scale. One financing structure addresses adoption barriers directly. Utility-linked pay-as-you-save lets utilities fund upgrades and recover costs through meter charges. Charges stay below estimated savings, so cash flow is positive from day one. Because obligations stay with the meter, tenants can adopt too, solving the split incentive barrier that has stalled conversions for decades. The irrigation paradox is clear. Water per acre fell from over 2 acre-feet in 1979 to about 1.5, while yields rose. That looks like conservation until you realize that without volumetric extraction caps, without consumptive use rights, and without satellite evapotranspiration monitoring, efficiency can still speed Ogallala and Central Valley depletion. In 35% of the southern high plains, this is no longer a projection, it is a countdown.